Is the bull market that you've come to know and love officially over? It's starting to sure feel like it. I mean, earlier today, you saw the major U.S. indices down something like 3%. It feels like the death of a bull market. And you look at fan favorites like Google or Alphabet stock leading the way down, 4% decline. Another investor favorite, Shopify, down 30% just this past month, also down 4% today. And you have folks coming out of the woodworks like Michael Burry saying, look, at least I tried. I tried to warn you effectively about this downturn that we're facing. And the question is, how much downside is there? You're looking down and you're trying to figure out, is there a lot more pain, to this bloodbath? And, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. And so I'm going to try to take a realistic outlook looking at one company's financials to sort of give a good example of what some of these companies like Google, like Shopify, even Starbucks could do in the years ahead. So let's sort of talk about that framework real quick. If this is your first time tuning in, please make a point of hitting that thumbs up, hit that subscribe button. And so, as we're potentially looking down, let's look at this example company where over time, it's been around for a long time. It's pretty much tied to the economy. It's grown at a steady clip for many years. I mean, it does have its, lumps when the economy turns, but by and large, it has gone up for a very long period of time. And since the economy last peaked in, let's say, 2006, it's been growing earnings fairly steadily, around 3-4% a year, under 4%, plus it pays around 1-2% dividend. And so it does make you wonder, what would you pay for this sort of steady business really tied to the economy? What's this business worth? And, you start thinking about these different components. So, okay, it currently has around $205 in earnings. Given that it has, let's say, fairly slow growth, you're not really sure what the interest rate environment looks like 5 years from now. Let's say maybe somewhere between 15 times earnings and 25 times earnings. So that would get somewhere around $3,000 and around $5,000 because it currently has $205 in earnings. And so let's also imagine that, because arguably the economy is running hot, even have the Federal Reserve talking about that, which we'll talk about in a second. Let's imagine that there could be pressures in the future. Maybe that's, maybe you have some sort of pressure from, inflation, where if you effectively you have input costs moving higher, or you potentially even have a downturn where, all of a sudden there's less demand for things and so prices decline. So there's a lot of different ways earnings can fall. Part of it's from operational leverage. If there's a little hit to demand, sometimes your costs stay the same as you don't fire people, let's say, right away. And so your earnings fall really fast if demand starts to take a hit. And so looking at this, where it is, maybe assuming a 20% decline to earnings. It's currently around $205 earnings. Maybe in a downside, it's a 20% decline in earnings. So you get around 164 in earnings. Once again, that 15 to 25 times multiple, because we know it's fairly slow growth long term, gets you to around 2,500 versus 4,000, price. And so this is a ballpark figure for this sample company. And, regular viewers might have guessed by now, this is no ordinary company. We're actually talking about the S&P 500 here, which recently closed just shy of 4,300. And so using this back of the envelope math, it would suggest, oh, wow, the price, if you were to value it today, could really be anywhere from up 20% to down 40% from here. Assuming, hey, if there was a bad scenario play out where you could have, let's say, much lower earnings, could you have this sort of fear of earnings declining by 20%? We're going to talk about that risk, in a second. But even if earnings, let's say, stay flat, but you have some sort of multiple compression, then you're looking at down nearly 30%. So this does sort of show you can get a double whammy when times get rough, where you not only look at lower earnings, but you can also look at a lower earnings multiple that really drives stock prices significantly lower. And so looking at an example of Starbucks, for example, Starbucks, a lot of people love the stock, very steady. I've talked about it, that it used to be a very fast grower. You've had some challenges recently, but even Starbucks, which was previously growing very quickly and used to be an investor favorite, trading somewhere between 30 and 40 times earnings, well, now what ended up happening during the financial crisis, it fell down to like 8 times earnings. It just completely got slaughtered. And that's why it's important to understand that when times get tough, when you have economic downturns, valuations can really come under the gun. And so, look, I've talked about Google, but look, it's important to understand Google has a very strong advertising business, and advertising is ultimately tied to the economy. So if the economy starts slowing down, Google will definitely take a hit. It's also much bigger than when it was during the last great financial crisis. So, arguably, it's going to be harder for them to really hold up the ship if the economy starts to turn. They're much more sensitive to the economy at this stage in the game. So yes, I do own Google, but I look at it and I look at its valuation. Here it is, price to sales. I think the valuation is very, very reasonable. I have called it out that I do own it in full disclosure, and read the disclosure, disclaimer in the description of this video. But the reality is, if you look at the history of Google's valuation, you'll see that by no means in the last decade is it anywhere near its low. It could easily be much, much lower just based on where it previously traded. Back in 2013, not even looking at the great financial crisis, back in 2020, looking at this, it could easily trade much lower. How about Shopify, another company that I've called out that I like and own? Once again, it's important not only to recognize that someone can say they own something, but you always want to understand, well, how much of your portfolio is it? And it's when I own these things, that's part of the reason why I share with Unrivaled Investing subscribers. I share my portfolio, and you see, oh, this is how much he's actually betting on these things. So whenever you hear YouTubers say like, oh yeah, like I love this stock, you need to understand and think about, well, wait a second, is how much of this is your portfolio? And so I'm looking at Shopify and Google, and it's not like they're my biggest positions. I like them, but I haven't made them like outsized positions in my own portfolio. And I do like their prospects. Like my previous video on Google, I'm talking about things like, I think their artificial intelligence will change the world. It has immense potential. But going back to Shopify, look, this is a business that enables a bunch of small businesses. They will definitely get hurt in an economic pullback where they, those small businesses might feel the pinch, in which case that flows to Shopify. Now, historically, you do have, some businesses start opening up, new business launches during downturns, which could help Shopify. But Shopify is tied to the economy in the sense that they are leveraging the growth of their merchants. So if their merchants take a hit, so will Shopify. And so, looking at Shopify, which I own, the valuation has come down so significantly in short order. The stock has just gotten completely crushed. But the reality is, if you look back to where it was trading in 2016, 2017, it's still lower than where it is today. So you could argue, yeah, I mean, it could potentially get even lower from here just based on raw valuation. That's not even factoring in if there's like an economic recession. And so that raises the question of like, okay, how much lower can all this get? What is the odds that you get that sort of bloodbath, the elevator doors open and just blood is pouring out? This is like, what's the odds of that recession? What's the odds? And so here it is. This is the key thing that everyone's focusing on. The bond markets, the equity markets, is what is the Federal Reserve doing? Because they're ultimately the power player that decides what happens to the economy. And here it is, just this past week, you have Jerome Powell effectively saying, yeah, he's taking a harder outlook on inflation, making sure they crack down on it. And they're looking at half-point moves, so raising by a half a percentage, potentially a couple of them looking to front-end load the policy, saying, hey, we need to tighten this economy given how unsustainable this economy is. And this does create the concern of like, well, wait a second. You have Larry Summers, former Treasury Secretary, effectively call out like, look, when you have super tight jobs market, if you think you're going to be able to get a smooth landing, think again. The odds are that you are going to get a hard landing from here with economic monetary tightening, quantitative tightening, raising interest rates. This is a much tougher picture. This is not a Goldilocks picture that you're looking at. So how am I personally playing it? And once again, this is not financial advice. How am I personally considering it? I share this all on a weekly update at Unrivaled Investing. But there's a couple of key things, in terms of how I personally play it. First of all, I have a large cash position. Yeah, I know inflation's high, but the reality is seeing a stock price drop 30% is even worse than, let's say, even with inflation being what it is, that's much worse than just sitting on cash and losing that 5% or 10% a year. So I'm very cognizant of that. That said, I would absolutely love to deploy my capital, my personal cash, into stocks at just crazy cheap valuation. And once again, I'm trying to channel, Warren Buffett. I got a picture of him over my shoulder. And what's he do? He's constantly looking for great deals, and he only swings the bat when it's just super compelling. So when he sees a company that is given no credit for future growth, trades at 10 times earnings, then he makes a big bet. Or he sees a commodity company trading at 2 times earnings or 3 times earnings, then he makes a sizable bet. And that's what you've seen with Occidental, the commodity company trading at effectively 2 to 3 times when he was loading up shares. And Apple, back in 2018, he was trading at 10 times. So he looks for things where the valuation is just so compelling that the odds are more favorable that you get this great return. So I'm looking at the investment horizon saying, yeah, these valuations aren't crazy. Some of them are pretty good. They're not crazy, though. So I'm, for the most part, sitting tight, waiting for just big, fat pitches. Because when I ultimately plug that last bit of capital that I have, to plow it into the market, 30% plus my portfolio cash, waiting to plow it into the market. When I do that, I want to put it in just crazy high upside potential situations. Things where it's like, oh yeah, I think that the upside is 300, 400, 500% easily from here, recognizing that it might be hard to see it because maybe at that time you're in a recession and the results are currently going down, but it's taking a view that, oh, I think they'll actually start growing again. And that goes back to that prior example with the S&P 500. You get this double whammy during recessions where not only earnings go down, but you get this hit because folks want to give them an even lower valuation because they go, I don't know when things will get better. And so, I'm looking at this, I'm waiting for the big fat pitches, and I'm just not seeing, I'm just not seeing it. I'm not swinging yet. At that big pitch. If you think you have a couple of, interesting ideas where you're like, Daniel, this has immense free cash flow, it has a ton of growth potential, and it's not getting at that crazy valuation, I'd love to hear it. But the formula for finding those potential multi-baggers is pretty simple. It's like, hey, do you have a ton of growth going forward? And are you paying a very reasonable valuation for it? Are you paying a cheap valuation? And will it have significant free cash flow with that? And if you have those different components where it's like a cheap valuation, significant free cash flow, lots of growth, that's the recipe for happiness with the stock market. And I see a couple of those things where it's a lot of growth, potential free cash flow, but the valuation isn't necessarily there. So I want to find that trifecta, the triple bar on the slot machine with those potential multi-baggers. And I do call this out, when I share my portfolio with Unrivaled Investing subscribers, I do share, showing, hey, not only do I have some long position, I do have some shorts and hedges, betting against the market. And, arguably I called it out to subscribers, a few weeks ago, effectively saying, yeah, a lot of these sectors started turning, a lot of these economically sensitive sectors started turning lower in the last few weeks, sort of articulating to the market, yeah, like, hey, there might be a problem here. You saw it with transportation stocks turn lower. You saw it with semiconductor stocks turn lower. You even saw it with financial stocks turn lower. And oftentimes, some of these more economically sensitive sectors turn lower first. And that might be a signal, that might be a price signal to investors saying, hey, there might be a problem coming up. And looking at what the Federal Reserve's looking to do, the puzzle pieces are starting to fit together. Anywho, if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for tuning in.